Alrighty, so let me talk about how I'm approaching this market, how I'm thinking, how I'm moving forward, okay? Now, before I get into that, let me address one important thing, okay? Because Wall Street has mostly underperformed significantly this year in the market, right? Because most of them went into this year very bearish. The market blasted higher. A lot of people were left on the sideline saying, how the heck do I get in this thing? There's two ways they can catch their performance up to be somewhere in regards to SP 500. One way is they buy like crazy and hope the market pumps into year end. And we've talked about that on the channel before, right? But there's another way you can get there. It's another way you can get there. The S&P 500 goes down big. There's two ways of getting there to save Wall Street's butt. We don't know which one's going to play out here in this situation, but usually Wall Street's going to find a way to get themselves somewhat back in where the indexes are roughly, so their underperformance doesn't look so embarrassing to their clients, okay? I don't know which is going to be, whether they're going to pump the market like crazy and try to, race to the top, or whether we're going to get a massive sell-off here, and next thing you know, oh, hey, we were smart for not being, all in the market going into 2023. We'll see what happens, but there's two ways they'll get there. And they're probably going to get there. Let's just put it that way, because they always find a way to kind of get somewhere close to the indexes in general, okay? Now, me and my approach to the market, okay? So my focus is really three places right now. One is buying dividend stocks. There's a lot of great opportunities in dividend stocks, and I'm getting ahead of this, just like I got ahead last year with growth stocks. At the end of the day, like if we start to see that unemployment rates start to tick up in a significant way, believe me, money's going to flood into the dividend stocks. The Fed will start cutting rates, which is going to put obviously immense pressure on savings accounts, CD accounts, everything obviously in relation to that, right? Which, by the way, is going to be a very interesting phenomenon, because when the Fed starts lowering rates, right, all that money starts pouring out of savings accounts, CD accounts, or whatever. It's going to be leaving banks, and it's going to be looking for yield. It's going to be going into dividend stocks, in my opinion, right? But that's going to be an interesting kind of hole to fill for a lot of the banks, which is not going to be a good time if they're seeing massive outflows during a situation where, let's say, loans aren't being repaid and unemployment skyrocketing and things like that. But anyway, that's a whole subject for another day. But buying dividend stocks, definitely one of my huge focuses there. The yields are insane. The Ps are insane. The business models, many of the business models that are dividend stocks, they're going to perform well in a recession or not a recession, bottom line. Okay, I want to take healthy cash levels into 2024 overall, because I can just tell you, there's a lot of headwinds. There's so many things I didn't even cover in this video that I could have covered that are like black swan events that are out there. China, Taiwan, Russia, Ukraine. I mean, there's so many to get into in relation to that. Like if we have some sort of new spike in inflation, like my gosh, man. So nonetheless, I want to have healthy cash levels going into 2024. And I also need to finish out my hedges for 2024 overall, because I definitely, it's definitely a year I want to have some hedges on for the market in general. I've got a decent amount of them ready to rock and roll. I probably have a few more last stragglers to get done over this next, let's call it few months. And then I'll be ready to rock and roll for 24. So regardless of whatever the market throws at us, whether that's a big drop in the market in 24, whether that's a chilling market in 24, or whether, it's a great year and the economy's fine and, stocks roar, whatever the situation, I'll be prepped for that essentially. And so that's kind of what I'm looking for in 2024, because I don't think it's clear cut anyway that things are going to crash. I don't think it's clear cut that the market's going to skyrocket. And I don't think it's clear cut if things are going to be flat. I think we're in a very interesting time period. And the punch bowl's been obviously taken away by the Federal Reserve. And that makes things start to get really real, really fast. Skyworks Solutions. We're up about 31% on the stock, up about $16,000. Now, do keep in mind, this doesn't account for any dividends received from any of these stocks, which obviously Skyworks is a dividend payer. So we've made much more than that over the years of holding the stock, right? But when it comes to Skyworks, they're in a bad place short term. There's no doubt about it, okay? There's a reason the stock hasn't moved in a year, basically. No, the company trades relatively cheap. It trades at about 11 times this year's numbers. It does have a dividend yield of nearly 3%. But the problem with Skyworks is they get about, it's usually anywhere between 40 and 50% of their revenue from Apple. Here's the deal with Apple. iPhone revenues have been going down. Volumes have been going down. I wouldn't be surprised at all if iPhone volume's down again in 2024. So for Skyworks, it's, volume's everything for them, right? they only have so much content they can sell into an iPhone. Maybe it's $20, $25, $30 worth of content. So at the end of the day, it's all about volume. That's how they push up their numbers, right? Now, Skyworks has many other customers, keep in mind, outside of Apple, but Apple's such a significant customer for them. So if iPhone volumes aren't very exciting over this next, let's just say 12 months, it's going to be a holdback for Skyworks overall, okay? So this is something to kind of keep in mind here. Also, there's a few competitors in regards to Skyworks, but the problem is these companies usually work so close together, it's hard to just rip and replace. For a company like Skyworks, same thing with Cirrus Logic, ticker symbol Cruise. It's a stock I owned in the past, done me tremendous. That's another semiconductor company that's really in the audio space. When it comes to Apple, these companies usually work close together. So they're seen as like, oh, you can just rip these out, throw another chip supplier in there. It doesn't really work like that, especially when, you got to understand, Apple's working on iPhones 2 and 3 years before they ever come out. This iPhone that's about to be shown off and come out, this iPhone's been in the works for quite a while now at this point in time, okay? At least a couple years. And so that's something to kind of take into account in regards to Apple, Skyworks, and all these different companies in general. So balance sheet's phenomenal at this company, phenomenal management team. It's just not the most exciting stock in the short term. Now, with that being said, would I be a buyer of Skyworks Solutions? And the answer to that is probably, especially if the stock goes any lower. Let's say Apple gets hit hard over this next 6 months or whatever, right? A lot of people are like, oh, iPhone 15 is not going to move volumes, revenue is going to be down next year, profitability is going to be down for Apple, blah, blah, blah. Okay, let's say Skyworks goes to the 80s. I'll likely be picking up shares of Skyworks, especially if for any reason this position went negative into the red. Definitely a pickup for me. There's always a potential that Apple could want to replace Skyworks with their own chips and try to do their own thing. But you got to understand there's so many patents that go into that. They could end up in a legal mess. Many times it doesn't make sense for Apple to do something like that. So Skyworks Solutions, great company, not in a great spot short term. Okay, and I might be buying it if the stock was to go down a bunch in the short term. So I think an important thing to think about in regards to the market is the market's always looking 6 to 12 months. I always call it the baby scenario. They're really looking like 9 months out on average, right? Some are looking more toward 6, some are looking more toward 12. And I'm talking about the big players in general in the market, right? Hedge funds and those sorts of folks that really control a ton of money. So let's look at it from their standpoint. Let's think about the next 9 months, right? I think there's I don't think there's many people worried about the remainder of this year. So let's just call it the next 4 months, okay? So you take that out. Then you say, well, what about right after, once we get in the new year? Yeah, there's a potential that things could weaken there, right? Definitely a potential there. But I don't think a lot of the big money folks are necessarily convinced that, oh yeah, everything's going to tank at the beginning of next year. So then that takes you all the way out to the second half. But I don't think anybody really has a clear judgment on what's going to happen in the second half of 2024 right now. Everybody's just kind of thinking about the end of this year and into the beginning of next year. And I just don't think big money is convinced we're going to have a massive recession in the next 6 to 9 months. So that's where big money's kind of focused, and they're looking and they're saying, well, at the end of the day, we can't just price in a hard landing scenario, a big recession, because we don't know if that's for sure what's going to play out, right? Then also you take into account that, okay, let's say that we have that. Where do you think rates are going? Where do you think the Fed funds rate is going? Of course, it's going back down to zero. If you have a hard landing, they're going back down to zero. And they'll do it in a snap of a flip and flapjack and fingers, as we know. It doesn't matter what inflation's at, because, by the way, if you have a hard landing, we're going into deflation. It's just a question of how bad's the deflation. Look what happened in the great financial crisis. So in a hard landing scenario, okay, you're back at rates at zero again. You're back to quantitative easing, and you're back to money printing and a fun next 5 years. So that's where you get into this whole scenario, and the market starts to look out, and they're like, okay, so hard landing, we get rates back at zero, quantitative easing for years. It's not going to be a day. It's going to be years. It's not going to be a month. It's going to be years of quantitative easing if you have a true hard landing. Think about that for a moment. Years of quantitative easing, years of money printing. Let that sink in for a moment, okay? And then you back that up and you say, okay, if we don't have that, well, economy keeps chugging along. Earnings are good. Everything's good. What you got? What you got, okay? That's where, you have to be very selective in kind of the way you're positioning in the market. And you have to be very selective with kind of where your asset allocation is. But you can look at these things from multiple different sides, and I guarantee you that's how big money looks at these things. I've been doing this for 15 years. I know how these people think, man. Listen to them talk all the flip and flapjack in time. 15 years.